Hey everyone, welcome to the Real World of Wealth podcast. We're excited to have you here. My name is William Moon, your host, and today we're going to keep things practical. Yeah, we're going to be a little bit nerdy and we're going to try and make you laugh a few times too. And today we have the honor of having a very special guest. I have with me here Marie Cammack, and she is a licensed financial advisor with ICM Financial. And today we're going to be discussing all things rollovers with 401ks, working with an advisor, and a little tiny bit about wealth management as well, too. And so just full disclosure, this conversation is for educational purposes. It's not financial advice. If you need financial advice, please talk to a licensed financial advisor. So with that, let me introduce our guest speaker, Mrs. Marie here. She's located out in Southern California. She is a wife and a mother of two. She has her bachelor's of economics from UCLA. Go Bruins, right? And she has over 2 decades of working in the financial advisor sector. And as I've personally gotten to know Marie through masterminds and other events that we've networked in, I've seen that she's really on it when she's like on stage. She's really professional. But what I love most about you, Marie, is that you just say stuff like it is. No sugarcoat, nothing like that. And so thank you for being here with us and welcome to the podcast.
Thank you for having me. I'm very excited to be here and to really have a fun and educational conversation for your listeners, especially about this topic, because it's a big one. It comes up all the time.
Yes. Yeah, it is. So first 2 questions I have for you, just to get stuff started off. Number one, what led you to start working in the financial advising field? And number 2, just for fun, what would you say is the worst money advice you got in a barbecue?
Okay. Wow. I'm focusing on number 2. I should be thinking about number 1. So number 1, why did I become an advisor? Why did I get in this industry? So I did study economics at UCLA, as you mentioned, and I kind of had my vision leaving school because I studied economics, but I took a lot of electives in sociology and history classes, and I became a little more aware of the socioeconomic disparities of, the rich getting richer, poor getting poorer, things like that. I bartended while I was going to college, and I saw this other huge disparity of wealth because the bar I worked at, Sony Studios, the movie studio, was down the street. So there'd be nights where Sony came, closed the whole venue to have a post-production party, and I have movie stars at my bar. And then the next day, unfortunately, a gentleman with no home who oftentimes slept in our dumpster out back would come in for a drink. So just this huge disparity of wealth right in front of my eyes. And so my dream was, when I finished school, was to get a job, be a manager somewhere, become super rich, and then go back to underserved communities, donate my time and teach people how to do it. This was my pipe dream coming out of school. And then luckily I found the company where I still work at a career fair at UCLA, and learned that this career path as an advisor, I could actually do that as my career on a day-to-day, help close that wealth gap, bring this information of knowledge that can really impact families for generations, and many people just don't have access to it. I wanted to bridge that gap and reduce the barriers to entry and make sure everyone could have access to good advice, not just wealthy people. And that's why I'm still doing it, because it's really aligned with my goals and purpose, and I find joy in it. So that's why I want to be an advisor and why I'm still an advisor. And then,
So when you were working at the bar, did you have like big names other people would know?
oh yeah, the most memorable name I can think of is Lily Tomlin saying karaoke at the corner of my bar, and that was super fun.
That's awesome. That's awesome.
Yeah.
And so barbecue advice.
Yes. Okay. I forgot the second question that I was focused on. I completely forgot. So, what's the worst advice I've heard like at a barbecue when it comes to money?
Yes.
Oof. Okay, I'm going to go with more of a category of advice because I've been doing this a long time. So over the years, the topic changes, but the gist of it is when I hear people talking about like the next hot thing, and it's the hot stock tip, or put all your money in real estate, or Bitcoin or something, chasing these things. And generally, the conversations talk about all the good, none of the bad. They're very imbalanced. And the main thing is the topic's all about what you can make. And there's nothing about the risk or concentration or should I. And they all kind of fall under that category of getting rich quick. And how can I get a quick pop of it? And what I have found to really hold true with the clients I've worked with over the years, like the wealthiest clients I have, that's not how they built wealth. That's not how they accumulated wealth. While some of them might have had a big liquidity event like that, an inheritance, or their company went public, or a settlement, sure, but it wasn't like they put their money in something that like quadrupled in value and now they're set for life, right? Because it's like easy come, easy go. And I don't think that getting rich quick is very different than building long-term wealth and that's sustainable. And so that's where most of that advice falls under that. But I remember in the real estate bubble, now 20 years ago, I knew there was a bubble when I'm at a restaurant and the person like clearing my dishes is talking about the 3 investment properties he has, all by, remortgaging his primary residence and negative amortization loans. And I kind of remember that day thinking, I think there's a bubble. There might be a bubble, right? So
Yeah, that's rough. And it's so true. And that what you just shared could be very controversial in today's economy. But I think it's just important, when there's time-tested strategies.
right.
And we even learn them as little kids, and those same kind of principles we learn as little kids could be used as earlier, right? Like never put all your eggs in one basket, right?
Yeah, exactly.
And stuff like that. So I think that's very very important. So that's awesome. So in plain English, Marie, when should someone even start thinking about just a 401k in general? And what are their options when they have one? Like what do you do with it?
So you mean like when someone's starting a job and they have a new 401k to sign up for, or more someone had a 401k and they're no longer at that company? Or do you want me to talk about both?
I was gonna say that's a good questions. Let's do both.
Okay. So let's talk about on the front end. You now are working somewhere and you have the option to put money into the employer sponsored retirement plan, right? One of the most common ones is a 401k plan. And essentially, I think it's important to understand how the plan works. And a few things to make sure you understand is when you put your money in, what are the tax benefits? So I think looking at how and when your money is taxed is important. The other thing is to always look at access, because if you actually needed the money, could you get it? How could you get it? If you were still working there or if you weren't. So I think a lot of people jump right into, okay, investments and fees, and sometimes skip a step that's really important, which is evaluating the tax consequences and your ability to access the money. So all I'm saying there is just make sure you understand it. Ask some questions, read the information. Don't just blindly put your money in it. But one of the things that's pretty nice about a plan at work is some companies, when you put money in, they match your contributions. It's like free money. So you put money in, they put money in. So going back to the get rich quick schemes, right? That we were saying was bad advice at a barbecue. Now, I mean, this is something we're built in. If they're matching, say, dollar for dollar, I put in $1, they put in $1. That's 100% return on my money instantly, right?
Yeah. You know what's so funny about that? Is while you were sharing that, it reminded me, I remember the first time I actually learned about 401ks and what they were. I was a manager at Panda Express, and my overseeing manager over me came to me and let me know, hey, you qualify to the company's benefits and you could put in the 401k. And I still remember to this day asking her, what is that? Like I had no idea. I was 19 years old. And she was like, it's something like they take money from your check and they put it away for you. And literally all the words that I heard was that they're going to take money out of your paycheck. Like I still remember that moment.
Right. Yeah.
It's crazy because had I looked in a little bit more in my younger age, it would have made such a massive difference. Like I still to this day, I don't know Panda Express matches, but I was like,
right.
if I had known that and a little bit more about what you just said, that would have made such a difference. It's so, it's
I'm
just
I'm
crazy.
I'm really grateful you shared that story because I had a conversation recently with a client who was looking at changing jobs, and this a similar topic came up. Because he was so focused on looking at the compensation difference between the two jobs of like income or what my net take home pay was. He wasn't necessarily factoring in the benefits, the match, because that's a form of compensation.
Right.
This is now money for
Yep.
you that now can compound long term. So I do think people tend to over focus, right, on like pay or net direct deposit and might not always be factoring in this is
Right.
another form of compensation. It's going into your pocket. It's just your long-term pocket. It's the pocket you pull from later versus the pocket that you're spending now. But I will say
Right.
about the match, actually, since we're talking about that, and the free money is pretty intriguing. You're pretty hard pressed to find an advisor that would say, don't take free money, right? But no, with a match on your 401k, one is not guaranteed. An employer can choose to match or not year by year, and they can make changes to that. And two, many times there's a vesting schedule. So employers use this match to say, hey, we really want you to work here, come work here, look at our great benefits. You put money in retirement, we'll match you, but you need to stay here. Because if you quit, within the next, and this is company specific, this is why you'd want to know what it was. If you were to quit in the next 3 years or 5 years, your money you put in is always yours, but the employer match money, you might not get all of it if you leave within the 3 to 5 years or whatnot. So, coming back to when should I be looking at this and how much should I put in or how do I evaluate that? Step one, as I said, understand the plan and then look at your plan because every 401k is different. People think all 401ks are the same, always put money in, never do this. It's just not true. Every plan at the employer gets to pick. They check the boxes. You can do this, you can't do this. So understand your plan and how it works and then decide how much to put in. So that's where I think at looking at the 401k is when you start a new job and you become eligible for the 401k plan, take a minute, learn about it, ask some questions, and make an informed decision on how much to put in and in which bucket.
Right. Yeah, that's very wise advice. So what about after then when someone leaves their job and they have an old 401k?
Yeah.
Let's talk about that.
Yeah, let's talk about that. So, what makes something considered an old 401k? It's when you no longer work for the company who offered the plan. So, anytime you change jobs or leave that employer, you have a decision to make of what you want to do with this old 401k plan. I have seen over the years many people just leave them and leave them where they are, and there might be advantages to doing that as part of what we'll kind of talk through today, pros and cons and all of that. But one of the downsides to that potentially is if you change jobs and over the years you start to collect all these old 401ks and you start to lose track of them or you move and you don't update your address. And I know people are listening going, oh, please, I'm not going to just lose that account or I'd update my address. Well, in theory, right? And I'll just tell you firsthand experience, people don't, they forget. I mean, I had a client who's a physician who just recently we wanted to finally roll over this old 401k. They had an address on file from like 3 years, 3 moves, not 3 years, 3 moves ago. And we had to do all this stuff to update it just so he could move it. And he was actually able to locate it. I've had other clients who were like, oh, I worked for this company 20 years ago. I don't know whatever happened. I just stopped getting statements. So that can and does happen. So
Whole thing, yeah.
don't just leave it behind without at least keep your information up to date if you do make that choice, right? So I do think when you change jobs, because now you're eligible to make changes to the plan, which I think goes back to that first part where we were talking about when you're starting a job and you still work there and you're putting money into a 401k plan. I think it's very important that people understand, and a lot of people don't talk about this, with a 401k plan. A lot of people know, okay, it's for retirement. If I take it out before age 59 and a half, there'll be taxes and penalties. Like a lot of people might know that. But
Mhm.
many people don't realize if you still work for the company and your money's in the 401k plan, even if you wanted to pay the penalty and the taxes because you really needed the money, you might not be able to get it out. Because
True.
you still work there, you're very limited on if you can access money, how much, and generally, it's almost always subject to tax and penalty. There's only a very few number of ways to get out without penalty. from a 401k plan while you're still employed. So
Right.
there's that. Okay. So now you have this triggering event. You no longer work at that company. You've separated from service, they call it. Now you have choices. You can take the money out, move it, transfer it. So it becomes a great point in time to evaluate those options. Just like when you started participating in the plan, you looked at things like tax benefits, your ability to access it, any kind of perks or benefits you're getting. Now you're going to do that at this point in time. The other time, so in addition to changing jobs, because now you might have a new plan available, you're leaving that company, right? You want to evaluate it. Other times in life, let's say you left it where it was, but down the road, you might revisit that idea of doing something different with it. That could be because of a life event. Maybe you now have start a family or you're buying a home, and it might be advantageous to roll it over now. So you have more access to it, for example. So you might have a big life event change in your family situation or losing a job or buying new property, whatever that might be. The other time I think it makes sense to kind of look at these things on the same vein of a life event, but getting closer to retirement. Because then you might want to shift your approach or how you're managing your money and might a little more customized. So that would be worth looking at it. And then the third, I think I'm on number 3. The third reason would be as your balance grows. Because as your balance gets higher, depending on the fee structure of the plan, you now are probably paying more of the plan expenses because you have more money in the plan, or you have more money in the plan. So now if you did move the money outside of the plan, you might have access to more financial vehicles than you did inside the plan because the balance has grown. And I think early on when you're saving and growing your money, you're like, great, this is awesome. Autopilot, set it and forget it. And then it's when I have my clients that get older and there's a lot more money in it and they're getting closer to retirement. And then they're like, so what if I wanted to do X, Y, Z and make adjustments? And then that's when they start to look to do something different potentially with the account. So
That's
hopefully
awesome.
so short of it is, right, when you're changing, when you leave that company, you want to look at it because you do have a decision to make right then and there. And then
Right.
various life events, getting close to retirement, and as your balance grows, it's always important to kind of keep revisiting.
Correct. Yeah. And so when people try and move money over themselves, if they're like, okay, I've looked in this, a lot of our audience is people looking for rollovers and stuff like that or information. What are some common mistakes that you see people make when they're trying to do that, so that our viewers can avoid common pitfalls?
Yes. So number one mistake, it's the paperwork you have to fill out to tell them what to do with your money. So now you're in this position, you're deciding you want to move the money out of the old 401k, let's say. You're going to have a process where you have to tell this company where the money is, what you want them to do with the money. And there's usually a form or you're doing it online or over the phone. And you have to indicate the option you want. And checking the wrong box, if it was paper, but even verbalizing it or clicking the wrong box, can result in like huge tax consequences. Like if you meant to roll it to an IRA, but you checked the box saying you were rolling it to a Roth IRA, for example, all that money would be taxable this year and added to your income this year because you just checked the wrong box mistakenly. So that's that. Yeah, I mean, that is the number one because you're trying to express what you want done with the money, but then the actual execution of it didn't go as planned. So that number one is always the biggest. And like, how do we unwind that? Part of that too has to do with going back to understanding what you have in the account and looking at the statement, because nowadays a 401k plan, you could have some money that is what we call pre-tax or traditional money, where you got a tax deduction on the way in, on the money you put in. The employer's money that goes in that way, pre-tax, we call it. It's never been taxed. So when you roll that money out, you're rolling that to a certain type of IRA. And if you have Roth money in your 401k plan, you're rolling that part of the account to a Roth IRA. And I actually just helped a client do this online. She was online trying to indicate what she wanted. And it was really confusing, the questions they were asking. So I said, let's do a screen share. And I mean, I've done this a million times, right? And even the first question, the way they worded it was so confusing because she had pre-tax and Roth, money. And I'm reading through it, and we had to do it twice and like back out and redo it because it was very confusing wording, even for someone who does it all the time. So paperwork, understanding the options, call the 1-800 number, double check with someone, like just don't check the wrong box. So that's number one. I was going to see if I had other notes. I tried to think of other mistakes. I think number one's the biggest, okay? But some of the other ones that I see is people kind of get into default thinking. So I've left this company. I have this 401k plan. I have essentially four options of what I can do with it. And let's say whatever you did the first time you left a company, let's say you rolled it to an IRA or you cashed it out or you rolled it to your new 401k. I see that common. You did that the first time. So now every time you change jobs, you do the same thing, right? There's like this bias to it. There's a familiarity. It's default thinking. Oh, I read an article one time that said you should always do that. Or my coworker said do that. So we start to get into this group thinking it always must and never. You always do that. I think that is just never a good thing in anything really in life, but things change, rules change, fees change, investments change, your circumstance changes, and it should always be an individualized decision. So I think to pause and think and reevaluate and not just kind of default thinking is important. And then the third mistake, I think, is kind of it kind of goes to what I mentioned on the front end of putting money into a 401k plan. I tend to see people over focus on one thing, right? So I'm deciding what to do with my money, and they just over focus on just one of the many factors to consider. So maybe they're just only looking at, say, the fees, for example, or they're only looking at the investment options. And then maybe they're not factoring in accessibility, right? Or customization or flexibility. So it's kind of like tunnel vision. So that's where I think it's important to just pause, zoom out, make sure you have all the relevant info available, and then, yeah, decide and move forward. So those would be three that come to mind.
I like those, especially the second one. I didn't think of that, but it's so true how people get into default thinking with that. And it's always important just, I think, to assess. So for
Yeah,
sure.
I've done work in a certification related to behavioral finance that really looks around the psychology of how people make financial decisions. And we talked quite a bit about that. Some of these biases that come in and create this automatic thinking, and your brain is actually designed to do that, to create these shortcuts on purpose, because there's just too much, right? We have too much input and output. And sometimes those shortcuts serve you well from an efficiency perspective, but sometimes, right, they can work against you because you're just defaulting. So
Right, yeah. So we've talked about having a 401k and some things about what you could do with your 401k after, you've left your job. What would you say are some of the top benefits or reasons why someone would what are the top benefits for rolling over your 401k into an IRA?
to an IRA, yeah. Yeah, so of course, the financial advisor's favorite answer, it depends. It does depend on what the benefits are, but in a nutshell, right? Well, if we just briefly list the four options you have, just to give some context, but option one is you leave it where it is, right? Option two is you could cash it out. Option three is you could roll it to an IRA, or four, you could roll it to a Roth IRA. So those are the four options. I think if we talk about number one is cashing it out, all the other three are some kind of rollover. So if we just want to address number one first, and then we can touch on the benefits of rolling it. So first, if you cash it out, okay, it depends on your age. But if you are under the age of 59 and a half years old, whatever money you take out, you're going to have to pay tax on it, likely penalty at the federal and state level. There are some exceptions. If there was Roth money in it because it's taxed differently, same thing, like the money you put in might not be subject to tax and penalty, but the growth would be. So just know that it depends on your age, and you should understand what those consequences are before you choose to cash it out. I had a client recently, they were changing jobs. They were going to have a little bit of a pay decrease for a period of time. And he wanted to evaluate, living off the 401k, to bridge that gap or so. And he's in his 40s, and we ran the numbers, and he has, a couple 100,000 in the 401k. And I mean, he would have lost half of it. It was between 45 and 50% of the money would have gone to taxes and penalties. And so it just becomes one of those, You can look at what you're going to gain. By now, I have this money to bridge this gap for my income from my family. But then you have to look at not just what you've lost in the taxes now paid out that you don't get, but all the money you could have earned on it, right? So just be aware of it. I'm not saying don't do it, right? Everyone's situation is different, and your family, you might need it. It's your money. Go for it, right? Like, who am I to say? But just make sure you understand it first, not be blindsided by it. So that's the cash out. So now we have the three options for rolling it, right? And the first one is you're in a 401k plan now, let's say, or an employer plan. Let's just say 401k to keep it simple because there's so many different types. I'm in a 401k now. I have a new job, and this employer also offers a 401k plan. If this company allows it, because they might not, okay, you can roll your old 401k into this new 401k plan. So that's an option. Or you could say, I don't want to roll it to my new company's retirement plan. I want to roll it to my own retirement account, right? And that's kind of where we see a decision tree now. It's like, I don't want to cash it out. I know that. I don't want to pay tax. I don't want to pay penalties. I want to keep it in retirement world. But do I do it at my new company or do I do it on my own, right? And so this is where the default thinking, as we're talking about, kind of might get in the way, because I've read so many articles and overheard so many people make these generalizations about 401ks and IRAs in general. Things I've heard. The fees on 401ks are always lower. A 401k is always better than an IRA. IRAs are risky, 401ks are not. These are some of the misstatements I've heard. And what people are doing is they're taking these characteristics and applying them to the type of account like 401k or IRA. And the reality is it's not the type of account that determines the fees,
Ah,
the
yeah,
risk, the results. It's
yeah,
what's inside of it, right? Like, and
yeah.
so there's that. So unfortunately, when people think, oh, a 401k always has lower fees, let's say that is something that came into their universe. And so now they think, oh, I always roll into another 401k because the fees are always lower, right? The reality is you want to look at what the fees are because they are not always lower in a 401k environment than in an IRA. That's not an always. And I help companies with 401k plans. I wear both hats there. And I will tell you, when a company offers a 401k plan, you have the investments inside, they have their expenses, but then there's plan expenses for the actual administration of this plan. Most employers, especially small employers and even large employers, that administrative expense for just running the plan, they often pass that down to all their participants as a percentage fee on your account balance.
Which if you
So,
hide it, they could kind of hide it.
absolutely.
Yeah, because you
Yeah,
don't see it. And they're like, what are you talking about? My 401k, I don't have fees. I don't pay fees on my 401k.
you just don't see them.
Right.
I mean, the reality is you don't see it come out of your statement. These are percentage fees built into the account. They're in a disclosure. They're not hiding them per se, but many people aren't even looking at it, reading it, and they just don't know about it, right? So, I would say what it's based on, just so you know, you have these plan expenses and they have a hard cost, like a dollar expense associated with them. So an employer could choose to write a check for those, and then the participants aren't paying them, right? So in those cases, it's like, yeah, oh yeah, my 401k plan, it's some huge employer, they've got billions of dollars, they've negotiated down the investment charges. Like I couldn't get that on my own if I wanted to. Okay, now we're talking, right? Now that's a 401k where you're like, hey man, yeah, that looks pretty good. I can't get that on my own if I tried. And then you have many 401k plans where there's this plan expense being passed down to you, and you have the investment fees plus that. So now it boils down to, could you maybe potentially invest in the same exact thing you're investing in the 401k plan outside of the plan and get a lower fee? Maybe, because you wouldn't have the plan expense fee. So I don't want to get too jargony, but the point is it's never and always must never. And the step you should take when you're looking to decide, do I keep it in this plan or do I roll it to my new plan or do I roll it to an account on my own? You want to start by understanding, besides the investment options, the costs associated with your current plan and the new plan. And those have to be disclosed to you. There is a plan information notice. If you click around enough on your portal, you'll find it. And it's a participant fee disclosure notice. A 404A5 is what it's called. And it will list all the investments, the performance, and all the fees. And oftentimes you'll see the fees are more than what people realize. So evaluating that is important. The other thing is on your new employer plan. Once you move your money there, the law of that plan is the law of the land, and you have to follow the rules of that plan. This is something I think is very important to distinguish between 401k plans and IRAs that nobody talks about enough, in my opinion. Because the IRS comes and says, hey, these accounts can do all these things. Here's the benefits, here's what you can do in them, right? In an IRA, when the IRS says an IRA account can do all these things, then everybody's IRA can do all of those things, right? Like it just is. When you have a 401k, here's how it really works. IRS says, hey, 401k plans, you can do all these things. And then your employer, hopefully with the advice of a good plan advisor, right, is going through and saying, yes, adopt that feature, adopt this feature. And so once you just don't, I guess my point is like in your old 401k plan, you might have been able to do certain things that you thought were pretty nice and interesting and you liked. Don't assume that your new plan will allow that. And I'm not just talking about investments. I'm talking about access. I'm talking about if you have a hardship and you need to withdraw money, can you? If you're still working there and you reach age 59 and a half, what are your options? If I roll money in and I'm still working there and I kind of change my mind and I want to roll money out, can I? Or do I have to wait till I quit this job? You know, I rarely hear people ever, besides our own community, I'm never hearing that at a barbecue, right? No one's saying, I was like, oh, 401ks are terrible or IRAs are good. No one's saying like, oh, if you checked your 404A5 disclosure, have you seen what percentage of the plan expenses you're paying? Like, people aren't looking at that. But that's what an advisor must do, right? Under our regulations, when it comes to retirement accounts, we act in a fiduciary capacity and we are here to help people ask the questions they don't know to ask. And then when they get the information, they're like, great, I have those fees. What does it mean? Right? Someone to
Right.
help you kind of work through that and translate to some extent, right? So anyway, so pros and cons on the 401k to 401k or advantages, hard to say because it's plan specific, right?
Mhm.
Hopefully in making the move, maybe you're getting access to more investment options or a lower cost structure, or maybe it's on par with what you have. So it's like, okay, great. I'm good. Keep it going. Consolidate them so I don't leave straggler plans, in my trail of crumbs of 401k plans behind me, right? And then you get that consolidation, all the money's in place. Like there's a lot of advantages and convenience to that, of course. Now, when it comes to rolling it to an IRA, right? Whenever you're going retirement to retirement, there's no tax today. So you're kind of keeping all of that the same. But with an IRA, now, if you wanted to add money, you could. Like that should be noted, right? An old 401k, if you no longer work there, you cannot add money to it. So that's a big differentiator right out the gate. But with an IRA, you're in control. Like really, like you are in control. You decide what it's in, right? If you want to go down to your local bank and open your IRA and put in a savings account or a CD, like you could choose to do that. It may not be in your best interest, but you can choose to do that. You have the flexibility and control to choose how your money is allocated. So that is one of a big differentiator because with a 401k plan, the employer comes up with the list of investment options you can pick from. And I will say most employers are advised to kind of have something of everything so people could, spread their money out, but not too many options. Because if you give people too many options, they don't know and they might hurt themselves, I guess, like put their money in the wrong things. So you're very rarely in a 401k plan going to see like sector investments. Like let's say you're really interested in investing in certain technologies or whatever. You're probably just going to see your basic investment options in a 401k plan, or if I wanted to buy individual stocks or, I want something that's guaranteed or won't lose money, right? Some 401k plans have those features, others don't, many don't, right? And so that's an advantage of an IRA. You can control how your money is growing and how it's allocated. The other thing is you have control over accessing it, right? Like even if you had to pay tax and penalty, you could say, okay, I want to pay tax and penalty and take my money out. And you could do that. Whereas your 401k, remember, if you're still working there, they might say you can't take it out, even if you wanted to, you know? 401k plans, though, some plans do allow loan provisions, which is a way you can kind of take out a loan on your plan, like loan money to yourself and pay it back. Whereas an IRA doesn't have that loan feature. So there are differences, yes, in fees and investments, but also in your ability to add money and take money out. So again, this is why I think default thinking works against you, and it depends on your life stage and your goals and what's important to you. The third thing, or the fourth now, I guess, option is you could roll it to a Roth IRA, right? And this is called a conversion. So it allows you to take this money that was in one type of tax bucket where nothing in the account has ever been taxed, and you can move it to a Roth IRA, which says, hey, government, I'll pay tax now, no penalty, but I'm gonna pay tax now on all the money in my account. And so now all the growth going forward, I never have to pay tax again, right? And so that could be an option that works for some people, depending on their income and tax situation. But you know, you got to factor that in, of course, and don't check the box by mistake, because then you'll be in a big surprise at tax time when you get your 1099.
Right.
So I mean, I
That
feel like that was a very long answer.
that is very detailed, but I think it's really good. I think it's really important for people to know, like, just to be aware of, which is kind of like the theme I'm hearing in with what you're saying, with that, is just kind of know your stuff and know what's happening in your situation, and don't be set in one way. I love what you said. It's never no, always, or never. I wrote that down.
Oh,
It's never no, always, or
yeah,
never.
correct. Yeah, whenever I hear always, must, never, you know, I cringe because I'm like, really? You can think of at least one circumstance. Yeah, but that's just me being, you know,
Oh
difficult.
no, and it's funny, side note, but sometimes that mindset can get instilled in us even as kids, and in our house, like with my kids, whenever they know that they're not supposed to say like permanent words like always or never or every time, because almost like that, I'll think of a situation like, oh, what about this, right? Because it's important, right?
Yes.
So even at a lower age, right? I think
Yes.
that's really important. So good. So this also reminds me too of, I remember in one of our masterminds you shared something that just, it blew my brain.
Mm.
And I loved your thought process. If you wouldn't mind sharing about how, when you were talking about sometimes when you work with a bigger firm for investment, wealth management, or whatever it is, right? When you're working with a bigger company helping you manage your money, a lot of times people would think, oh, these guys are a big company. They're going to do really big things with my money.
Mhm.
When in fact, what you were sharing was that's not always the case. And I just loved your thought process and your mindset on that. Would you mind sharing more about like that scenario and
Yeah,
that thought process?
happy to. I mean, you know, I shared why I got into this business was to help close the wealth gap. And I most of my career, I work with the average American, you know, people like me and my parents and, you know, everyday people. And through the course of my career, 20 plus years and being in management and more designations, I've increased my knowledge to a specialized degree where I'm brought in on more advanced cases, right? So I still serve average Americans. That's where my heart and passion is. And I'm the one sitting in the meetings with the clients with $26 million and $10 million and $15 million and whatnot. So I span the spectrum of seeing it, right? And I will say, even for me as an advisor, there was always this thought of like, well, at some point, right? You get so much money, no matter what firm you're working with, right? Whatever advisor, these big names that are household names that people have heard of forever, Wall Street companies, you know, we all have this outside looking in perspective of like, oh man, they must be like just getting everything, right? Top notch. They have access to things that we can't do. And oh, I wonder what that's like and how sophisticated it must be, right? We've all thought that. I mean, my clients all the time ask me, I agree. What do wealthy people do? Am I doing all the things wealthy people do? You know, so I know there's intrigue and curiosity even amongst advisors where we see like, oh wow, that firm works with these people with tens of millions of dollars. They must do all these interesting things. Okay. They don't. I mean, sorry, but I have an advisor on our team who specializes in working with individuals of that wealth level. So we've seen a lot more clients like that in the last few years than we had before. And I'm seeing these statements and how they're set up, and we're asking questions like, okay, so do you have an estate plan? Tell us about your insurance plan. And what do you know of the fees you're paying and how it's being invested? And they don't. They don't. The advisors come in, they've maybe helped them with investments only. They haven't even asked some of these questions that we're asking on the front end that I start with my average everyday people with, like goals and time frame and objectives and what are we trying to accomplish and making sure you have things in place if something happened to you or went wrong, you know. And I'm seeing people with a lot of wealth not having basic things in place. Or when they do have them in place, it turns out like, yeah, they're basic. It's the same thing. I mean, really, you might layer on a few extra complexities from an estate planning perspective. But if I zero it in on like the tools they're using from like financial tools, like investments or insurance tools, if I just keep it that focused, it's the same thing I'm offering my clients at a much lower wealth level. So I see this twofold. Okay. One, I see the benefit of that of like, hey, everyday people, guess what? Like I got in this business to close the access gap. Time has done some of that for us with technology and accessibility and apps and different ways you can manage your own money. That's the good news because I will tell you, most of the people listening to this probably have access to the same exact financial tools that these clients have access to. There are a few things that are for what we call accredited investors, where you have to have a certain income or net worth. But I will also tell you, those investments, they're speculative, they're concentrated, you can't access your money. So while great, I have access to these, they still might not meet your goals. And even when we have clients who have access to them, doesn't mean we're using them because it might not meet their situation. So the one side, the positive part of my epiphany was like, awesome. Everyday people, there is no access differential, right? Like they can access the same tools. But then the flip to it, the not so great side of that I saw was more for these wealthy clients. Because I'm like, you're telling me this person with the 20 million or 10 million has the same funds and investment models and the same fee as the person with $100,000. And a lot of these really big firms, even at 20 million, you're small potatoes. I mean, I know you can play that back. Even at 20 million, you're small potatoes, right? And so they'll have a huge, group of clients who are working with the same model, the same kind of investment team. Again, whether you have the 20 million or the 1 million, because maybe their next tier of advanced services might not kick in till 50 or 100 or whoever, right? It depends on the firm. So that to me, I mean, as an advisor, looking at my own value proposition and how I serve clients, it was amazing because I just felt so honored to do what I do and validated that I am the work I put in at various wealth levels and customizing it and specializing it, as I know you do, William, because we care about our clients. We know the people behind these accounts. They're not just numbers on paper, and there really is a personalized relationship there. So that's what I started to see and was disappointed in a lot of ways, but then also kind of motivated. And I saw the light and the good in it as well.
Like you're on this like fine line where by sharing this, you're going to make some advisors mad, but at the same time, you're going to make a lot of potential financial advisor clients happy.
Yeah. I mean, it's a little bit like lifting the
It's
curtain.
true.
It's
It's the
lifting the
truth.
curtain, right? There's marketing in all businesses and all industries. And I guess the core of it is all the firms out there will put on a face, a public facing optics of we're full service, we're holistic, we do all these things. They're all saying that, and they do have the capabilities to do it. But what I'm now seeing firsthand, just because they can and they market that way, I haven't always seen it applied to actual clients. situations. And I don't want to make any broad strokes out here. I mean, within all firms, there's advisor teams who are doing that. Again, so I'm not making generalizations, but it's just more of that epiphany of like a preconceived notion or presumption I had of like added complexity at various wealth levels or added services or whatever. And it was like, no, not necessarily the case. So here I am guilty of always, must, and never, of assuming like, oh, well, if you have that, you must always get, all of the, not necessarily. Or when you're super wealthy, you must be set up. I mean, I did a radio show years and years ago where we looked at famous people who didn't have basic financial things in place. So it's kind of like there's all these assumptions people have. And it was really interesting, looking at different individuals and wills that were probated for decades and public record, like real basic stuff. So yeah, don't assume.
Don't assume. We always say assuming is the lowest form of communication, and it's always better to either be knowledgeable with good information or really just find out for yourself.
Yeah, so true. So true.
Yeah. So then, kind of wrapping stuff up here, let's transition to on the good end. What would you say are the benefits of a financial advisor, and what would good wealth management look like?
Great question. I'll keep it short. I'll try. I would say, so there's a lot of potential benefits to working with a financial advisor, and it also depends on the type of advisor you're working with. So I just want to put that out there. I think our industry does a terrible job of labeling us. Because if you hear the word financial advisor, like depending on the person and the firm, it can mean totally different things. And we can call ourselves different things. Like with my licenses, I could call myself financial consultant, wealth manager, financial planner, financial advisor. Like they're interchangeable. So that part is just, so there's a number of reasons of benefits of working with an advisor, but of course it depends on the type of advisor and what credentials they have. So just to put that out there. But I like to say it boils down to two things, right? In working with an advisor, two main benefits. Number one is their knowledge and expertise. I mean, at the end of the day, they specialize in this. This is what they do. Me and William, right? Like eat, sleep, drink it. That's a bit extreme, but it's our everyday. Like these rules on retirement accounts, we can spew them out because it's our everyday. Think of things that are your everyday that you can just kind of roll out and they're front of mind. So that's number one. It's for the knowledge and expertise and experience that they bring to the table to help you navigate these things and make informed decisions. I think the number two reason to work with an advisor is for access to financial tools you might not have access to on your own. Now, I know I just said, hey, good news is you have access to the same thing these wealthy people do. True, but I still meant through an advisor because there are a whole bunch, if I'm going to keep it simple. There are hundreds and thousands even of financial tools and instruments that exist that are not available direct to the public, where you have to work with a financial advisor because the financial institutions offering these vehicles want to know that you understand it and it's a good fit for you and that you should be using it. So that's one. So it's the knowledge, expertise. And number two is the access, because you can have access to institutional strategies that you might not access on your own. Now, whether they're right for your situation or not, to be determined. There are plenty of financial vehicles you can access on your own, but you're still limited, right? So an advisor just opens the gates a little more so that you're evaluating all your options and not just the ones that you're familiar with that are advertising direct to the public. So that's what I would say be two main reasons, benefits of working with an advisor.
I think those are perfect. And I'm glad you didn't mention like rate of returns, sector invest. If they put you in tech funds, they're amazing.
Definitely not.
There's so much more than just the investments that they offer, right? That is a big part of it.
But you're right. No, you're right, because at the end of the day, what I really think working with an advisor does for you, besides accessing the knowledge and the tools or the instruments, right? It's doing it in the context of a plan, right? Based on your goals and objectives and like what's in your best interest. So kind of pulling that like through line through it, because you're right. Like if you're just looking at performance, that's something you can't control, right? You can't control that. The advisor can't control it. I can't control global headlines, global events, major market shifts and economic events. None of us have control over that, but we can be proactive. We can plan for it. We can say what's the worst that can happen and know that we're insulated from it and we've factored it in. So that
Right.
to me, if you're looking to meet with an advisor, just be like, hey, can you give me a better return or lower my fee? I mean, you could, and there are advisors that could deliver on that. But I feel like if you're meeting with an advisor for performance of something that really they can't control, you're not really working with the advisor for the right reason in the first place. I mean, that could be an added benefit
So,
because they
yeah.
came up with a plan that might mitigate risk and have better outcomes, sure. But it can't be the only reason, right? Don't chase returns.
Right. Yeah. I think that's super huge. So
Because the flip of it too, like it's just unfortunately you do something long enough, you hear the good, the bad, and the ugly, right? And unfortunately, I'm at a stage now where I've been around the block and back a few times to where I've seen it. I've seen clients go to a seminar, hear about this hot thing that's so great, and look at the performance and the returns, and you can't go wrong, and there's no fee, and then they become my client years later.
share that they can't get out of.
What'd you say? What'd you say?
Said next thing they know after that happens is they own a timeshare that they can't get out
Yeah.
of.
Well, actually, pretty close, William. Even worse. I mean, honestly, it was a private placement, which is a non-registered security. It's something for people with high net worth and all these things. And it ended up being kind of a Ponzi scheme. And now there's lawsuits, and they're part of it, and they're probably never going to get their $400,000 back. But the return sounded good, and they said it was low risk, and all these things, and so I'm just saying, I find that if you're in a relationship with an advisor, where if you're not going, hey, here's my problem, here's what I want, fix it, but you're more of taking this approach of someone who's on your side of the table, they're on your team, they're understanding you and helping you make informed decisions, that's how you should work with a financial advisor. Not just be like, hey, what do you got that gives me this return, or can you help me source this product? You can work with advisors that way. It's very transactional, but I think you're better served working with an advisor in a way that's more of a planning capacity that looks at your big picture. It's like kids. I like this analogy, right? I'll use this with kids because it's easier and more obvious, right? So if I kind of took that approach of a transactional, say, approach of an advisor, and I have a client who comes to me and they go, I want this thing. So imagine it's a kid going, I want a lollipop, right? And so I, as an advisor, can be like, okay, well, let's look at all these lollipops, right? And how they taste and the flavor. And do you want it to crunch? Do you want it soft? Like, how do you want it to taste, right? Let me find the perfect lollipop for you. Okay. That's one way to work with an advisor. The other way, we're like, I choose to work with clients, and from what I know of William, he does too. I'm going to start and say, should it even be a lollipop? I mean, really, like, who's the one? If it was a kid, hey, mom, I want a lollipop. And I went, sure, let's find the perfect one, instead of saying, well, it's an hour to dinner. Maybe we should wait and do the lollipop later. Like I use that simple analogy because you're like, well, that seems obvious. And so I think an advisor, don't look at it as they're telling you can't have a lollipop or telling you what to do with your money, but they are that sounding board to first, let's stop and evaluate if you should even have a lollipop, right? Like, where's that in the decision tree?
Yeah.
And so that's where, when you're working with, like, say, wealth management or more of a comprehensive advisor that's looking at all the pieces or brings in other professionals, whatever, to look at those pieces for you, I think you're better served. Because when decisions are made in a silo, they don't factor everything in. And I see people do this. They'll have, like, their investment professional, their real estate professional, their insurance professional. And that's fine to diversify and have specialists, because it's good to work with specialists. Just also make sure there's at least one party in that mix, usually the advisor, who's aware of what all the other people are doing. Like, is your tax professional talking to your advisor? Does your insurance professional know that you have these retirement accounts in real estate? Because when you give limited information to people, for whatever reason that might be, and people choose to do this with money for a number of reasons, cultural or otherwise, like, the way I was raised with money, we don't talk about money. It's in my culture. I don't believe in that. They only need to know what I choose to tell them, all of that. And I don't want to be sold something, so I'm going to do this. All of that does a disservice to you, because as a professional, if you are a comprehensive advisor and you are licensed and you're a fiduciary, you want to know it all so that you are in fact giving people advice that's in their best interest. So
That's awesome. Well, I love it. I love it. Marie, it's been such an honor to have you on our Real World of Wealth podcast today. And so last question I have for you as we wrap up is if, or what would you say is the best way for viewers or individuals to connect with you?
Oh, yeah. Well, probably email. Excuse me, I'm choking right at the end there. My contact info, choke. No. No, I think email is probably best, or phone. So our office, I'm sure William will put it up, but we're here in Southern California. Our office number is 949-453-7660. That's the direct line to this office that you're looking at here in Costa Mesa. But we have offices throughout Southern California, and we do work virtually. So regardless of where you are, you can give us a call. My commitment to bridging that wealth gap, I will take the call and I will put you in touch with the right people if it's not me. And then, of course, my email, it's my first initial and my last name at osaicwealth.com. I'm sure William will put that up too.
I will make sure that we have that information with this video right below it. So
fantastic.
So thank you so much for being on our podcast today. And it was a pleasure chatting with you.
You as well, William.
Take care.
See ya.